So I have the distinguished honor to introduce our next two guests. David is the founder and president of Rosenberg Research, an economic and financial market consulting firm, provides insights to help investors make well-informed decisions. He is widely regarded as one of the most accurate and insightful economic forecasters today. Jeff Sherman, our very own Jeff Sherman, is the Deputy Chief Investment Officer at DoubleLine Capital. He is a highly respected portfolio manager and communicator and is known for his ability to explain complex economic concepts in a clear and concise way. We also invite you to tune into his popular podcast, The Sherman Show. So if you haven't gone to doubleline.com, go there and you can listen to Jeff Sherman on a weekly or at least bi-monthly basis. David and Jeff are two of the most knowledgeable and experienced voices today. They are both known for their independent thinking and sharp wit. Today, David and Jeff will be discussing the latest trends in the markets and their outlook for the economy. So at this point, please join me in welcoming David and Jeff Sherman.
Thanks, Ron. So speaking of complex concepts, I think we break down, econometrics 101 today and really distill it down into its core principles. What do you think, Dave?
Well, I want to drill down to how something that actually happened once could have a probability of 0. But I got to talk to Jeffrey at dinner about that over copious amounts of wine.
Right. Well, that's the difference between looking back at what things have occurred versus probabilistic in nature. So anyway, not to digress in all of this, but it's great to have you here, Dave, because what has changed in the last 2 months in markets? It's pricing, right? But you've been talking about the setup in the U.S. economy specifically, how that bleeds over to the rest of the world right now. But if you think about what happened in markets in the last 2 months, what changed besides sentiment?
Well, I want to say first about what has not changed, because people come out and say, well, it's because of this gargantuan fiscal deficit. But the bottom line is that back in January, the CBO said this year we're going to have a 5.5% deficit GDP ratio, which I understand is ridiculous, but that's what we're going to get. So,
in boom times, nonetheless.
Pardon?
Right? In what they consider boom times.
Yeah, but we're
right?
talking about we've had a 1 or 2 standard deviation event, in the bond market in the past several months, and something's taken the market by surprise. But it's not fiscal policy. Growth estimates really haven't budged. And despite all the talk about sticky inflation, we just got a core PCE print. The Fed bows down to the holy grail of the core PC deflator, comes at 0.1% sequentially in August, and the 3-month trend is running at 2.1%. Oh, head for the hills. And so it's not been inflation. Inflation expectations, if you look at the 5-year TIPS break-even levels, they started the year at 2.4. They're now less than 2.2. Mm-hmm. We're almost at the Fed's target. So it's not inflation expectations. It's not growth. It's not fiscal.
So why are real yields higher?
It's the Fed. It's the Fed. Look, here's the reality. They didn't hike rates at the September 20th meeting, but they may as well have raised rates because the guidance was so hawkish. They should have gone 50 basis points. They've been saying for so long, higher for longer, it's nothing new. And the bond market was calling the Fed's bluff. And when they made a radical change, that was a radical change to the dot plots on very little new information. You could argue at the margin the economy is doing better than expected, but not to the extent that you would revise your dot plots, the median dot plot, by 50 basis points. And actually, since the beginning of the year, the Fed's median dot plot for the end of 2024 was 4.1%. Today, it's 5.1. So there's been a level shift of 100 basis points in Fed expectations. And so that what's happened is the term premia has gone up. There's been nothing else influencing bond yields, not inflation expectations, not growth expectations. It's really about the reset of Fed expectations. So finally, the Fed got the bond market to break. And then everything priced off the bond market is breaking at the same time.
So a question on that. If it's a repricing of Fed expectations, why is something like the 2-year roughly where we were back in March of this year?
Well, the 2-year is basically what, we're about 5.1, 5.2.
About call it
thereabouts?
5.1. Yeah.
Okay, and so and the Fed says we're going to be there, through the balance of the year. Whether they raise rates one more time, maybe they will. But the front end, as Jeff Gundlach has said repeatedly, the front end is always the first part of the curve to sort of price in that terminal rate. The front end was never battling the Fed. It was the back end of the curve that was battling the Fed. And you could say that to some extent, maybe the back end of the curve still is. You got a 10-year note of, call it what, 470, 475. And so they're saying they're going to go, to 5.5, 5.75. Okay. So you can also ask the question, why is the 10-year note, why is the whole back end of the curve still below where the Fed says the Fed funds rate is going to be? So there's still this lingering, defiance by the back end, but they're no longer battling a 4.1% rate that they were pricing in the beginning of the year. But the Fed told you this is what we're going to be doing. Now they've had that level shift. So it's still a little bizarre, isn't it, that throughout all this and through this whole reset, because if the bond market really believed the Fed after everything that's happened and you had a normalized yield curve, well, where would the 10-year be? Probably 50, 75 basis points higher than it is today. Now, I don't know, maybe it'll get there. I don't think the economy can sustain it. I think we're going to find, and I'm sure we'll get into the economy, that there was a lot of plumbing going on this year. There's a lot of people saying that there's not going to be a recession because the recession hasn't started, which is ridiculous. It's like, I live in Toronto, so it's like me telling people, didn't snow in December in Toronto this year, therefore winter's been called off. I mean, give me a break. We had a lot of fiscal stimulus this year, and we had credit card usage. Now, of course, there's buyer's remorse, especially, I should say, lender's remorse. When you're taking a look at the delinquency rates on credit cards have gone up to where they were in the third quarter 2012. We've already taken out the worst of the pandemic in terms of credit card delinquencies. In the third quarter of 2012, the unemployment rate was over 8%, not south of 4%. Can you imagine what happens to delinquencies? Credit card usage, the average American household has 4 credit cards now. So I guess, one for the husband, one for the wife, one for the kid, and one for the dog. It's rather incredible. It's unprecedented, actually, but it financed 20% of consumer spending growth this year, just the credit card usage. It's not been organic income-based, despite what the Wall Street gurus might tell you. But you see, I think that where a lot of the macro bears like me got it wrong was the historical evidence shows that when the household sector is confronted with a stimulus check, historically, they spend half of it and they save half of it. And that's why Biden and his great team with Jared Bernstein said, go big or go home, back in March 2021. And they went 2.2 trillion in just cash here to everybody. And so their view was that they're going to spend half. We really want $1 trillion of stimulus, went 2.2 trillion. But who knew this whole concept of anger spending, and that YOLO would be the Main Street, was FOMO is to Wall Street. You only live. And so who knew that the behavior would be such that every penny of that stimulus would be spent? And that had a dramatic impact. That's why the biggest move this year in terms of an economic aggregate has been the personal savings rate, which has gone down more than a half percentage point. There's been revisions, but the savings rate before COVID was, say, 7-8%, and now it's down below 4%. And so what's happened is that consumers have really, the Energizer Bunny just kept on going. And so you've got this, I'm not going to say a false narrative. It's just that people think that we're in this period of sustained economic growth and we're going to stay here. But people have underestimated the fact that the stimulus is about to run out. Now, I'm not talking about the CHIPS Act. I'm not talking about the various parts of the ridiculous, Inflation Reduction Act, which is a bit of an oxymoron. But everybody says to me, well, but there's still that stimulus to the business sector. But the business sector is 10% of GDP.
Right.
I hate to insult any entrepreneurs in the crowd. I happen to be one, but we're 10% of GDP. The consumer is 70. And the stimulus for the consumer is about to run out. So my basic premise is that, part of the situation with interest rates has been the reset of the Fed. But I think that, let's face it, you're running money for a living, and everybody's throwing away their recession forecast. You were buying bonds at the beginning of the year. You thought we're going to have this financial crisis with SVB and with Federated and First Republic, and we thought there was going to be a cascading recession. Fed's going to cut rates, and so none of that really happened. But I'm getting a really strong sense that that the next 12 to 18 months are going to be really tough.
Let's talk about a different piece of the economy, because we focus so much on capital markets, right? We talk about the strength of the S&P companies, their ability to borrow in capital markets, low coupons, termed out. The debt has been really pushed out. You don't have big maturity walls till probably like early 26 when it comes to the investment grade market. Obviously, the high yield market has a little more pressure earlier because of shorter nature. But let's talk about the Main Street economy. Right? Let's talk about small business. We talk about this, the job creation. That's where a lot of the job creation has been in the last 2 years. It hasn't been the Fortune 500. It hasn't been the S&P companies. Where do they borrow today? They don't go to the capital markets. They get socked with something called the prime rate, right? We all know prime is 300 over SOFR, right? So the base rate starts at 8.5. How long can we maintain this economy? It's not the Fed funds rate that's impacting that side. Is this something that's problematic? I mean, because we talk about the banking sector, when we go back to what happened in March of this year, we know it gets financed through that mechanism. They don't go to JP Morgan to get a loan, right? They go to those areas. So what do you think about that piece of the economy? Is there something we should be looking at there for maybe these signs of weakness that we're not seeing in kind of the mega cap, the Magnificent Seven and the likes?
Well, right. Well, I think that the relative performance of the small caps are telling you something about the small business sector. I think that where does the small business sector get their financing? Well, they don't go to the market. They go to their regional banks. And so you look at the bank performance. The KBW is back heading towards the lows we had last March. You look at the regional banks, their relative underperformance, and so that's telling you something about how the regional banks are going to be constricting credit. And that's going to have a massive impact, a much bigger impact on small business. So it's not just the cost of credit, it's also the availability of credit.
Right.
And so you're going to be seeing, and that's the thing that you don't see in the data, because so much of the CapEx that you're seeing is, I mean, we do have a boom in this country in industrial construction. That is like the CHIPS Act is working. We have not a manufacturing production boom, but the construction of manufacturing facilities.
We saw the upticks in the PMI data.
Yeah, well, the PMI
it's
data
still a little weak, but
the PMI data, and I wrote about it, was a lot of inconsistencies in that number. But even with that number, it was 49. Better than expected, but it was still contraction.
But the employment side was pretty strong too, right? That's what you're seeing part of that.
Again, it was very weird because you didn't get that impulse from the ADP number.
Yeah.
So it was very, it was a very bizarre ISM number. And so from the manufacturing side, what's interesting is we're building all these facilities, but there's no production. So, I mean, they're obviously hoping we're going to build these facilities, and then the U.S. will become a superconductor
we want to
producer
replicate
again,
TSMC,
but I don't know.
right?
But I think these facilities will get mothballed. But the hope is that this will help get Biden reelected next year. So I think was more political than anything else, and maybe another way to screw China. But back to your point, yeah, I think that that the small business sector, that the small cap stock relative performance is telling you something about what's going to happen with small business, and then you're going to trace that through to employment. And employment's always last man standing as you go into recession. Everybody's saying, well, look at the claims numbers, look at employment. But it's not unusual to have employment even rising into the early stage of the recession. It's always the last man standing. If you're waiting for employment to go down, we're going to get a fresh number tomorrow. And it's usually too late. The trapdoor's already opened up by the time they start to let go of people.
Yeah. Well, I think that's what we've heard, from business leaders too, just the difficulty of finding workers and the likes. If you think about where the Fed talks about wage growth and believing in the Phillips curve, what are you getting the signals from the wage growth? It's obviously decelerated.
Yeah.
But I keep hearing Powell say the current level of wage growth is inconsistent with a 2% inflation rate. I mean, there's nothing. He doesn't say anything in there. But what do you think would actually get them comfortable? Is it really just CPI coming down? What is the variable that they're looking for here?
Well, I mean, they're what they want to see is slack emerge in the labor market. So in other words, what they want to see is they want to see the participation rate go up. They want to see the unemployment rate go up, and that'll make them very comfortable. Now, I don't give a lot of stock in, we have the American Airlines, that settlement over there, and we had the UPS workers over here, and now we've got the UAW strike. But, when you're taking a look at the proletariat, the working class, they signed these 4-year contracts 4 years ago, and they got screwed because of what happened with inflation over that 18-month period, and from 2021, 2022. Meanwhile, we all know what profit margins did in the past few years, and they went to record high levels.
But that was ultimately inflationary, though, right?
Not,
I mean, it was the companies taking advantage of it
absolutely.
as well.
These
right?
Look, I'm not a union activist. Okay, I'm a capitalist. Which when I see that in the U.S., I get a standing ovation. When I say it in Canada, I get booed off the stage. But the reality is that when you're taking a look in the past 3 years in real terms, the average wage in real terms is -1% at an annual rate. -1% over 3 years. That hasn't happened since 1992. When Alan Greenspan was lamenting about 60-mile-an-hour headwinds for the economy. So, I'm not seeing this as a wage price spiral. I see this as a catch-up. But you see, the way the Fed's looking at it, the Fed's not looking at it the way I'm looking at it. And I don't control the monetary levers. So I have to have my opinion, but then I have to interpret what is it that the Fed's looking at. So the Fed's looking at all these wage settlements, and they're looking at the UAW, and they're saying this emboldened worker. This would not be happening if the labor market wasn't tight. The Fed is looking at this as another sign that the labor market is just too damn tight. So what metric? No, they're not going to wait for core inflation to get to 2%. They're not that crazy, okay? But I think what would make them comfortable would be the unemployment rate. We've already gone from 3.4 to 3.8, and we go to 4.1, 4.2, 4.5. They'll be telling a different story.
But isn't 4.5 recessionary once you come off these levels?
Yeah. But that's what I mean. They'll be, look, I'm not, I can bend, but I'm not going to break. I was close to bending in 2007. I didn't break. And one thing we have to know about the Fed is that they will pivot. They will pivot. They will be forced to pivot. We'll be talking about something else. This is a central bank that 2 years ago, okay, not 2 decades ago, not 2 centuries ago, 2 years ago, it was about transitory.
With the same leadership, by the way.
And now we're
with the same leadership.
And we should have faded transitory. Although I would say, putting on our big picture hat, that maybe 18 months of accelerating inflation, albeit to 9%, maybe in the overall annals of economic history, that actually was temporary. But look, when you're the world's central banker and you're serving your last term, Jay Powell is being compared to Arthur Burns, which is like, I guess, first baseman being compared to Bill Buckner, although he was a legend, one play. But being compared to Arthur Burns is it's really shameful, right? Yeah. And embarrassing. So I think there's a lot of hubris involved. But I actually think that, and I'm sticking with the call, that at this stage, there is not enough Fed easing priced in next year. I think that people who threw away caution to the wind, and they threw their recession forecast in the wastepaper bucket, I think is a big mistake. Difference between saying the recession's been delayed, but to say that it's been derailed is then to tell everybody in this room, guess what? Guess what? The business cycle's been repealed. And interest rates don't matter. And there's no such thing as policy lags. None of that is true. They all exist. And I'll tell you that I'm getting the same sense like I had in '07. Maybe the stock market now, same complacency we had through much of '07. The stock market peaked in October of '07. I remember on October 9th of '07, the S&P hit an all-time high of 1565. I went to the Fed in Washington that day and gave a presentation, and I was loaded for bear. And if you remember at that period, we were coming off, remember in the summer, we spiked up. We got to like 530, 535 intraday in the 10-year note, like out of nowhere. Stock market hadn't peaked yet. It peaked in October 9th of '07. I'm there in the Fed, and they're laughing at me. And at the end of the presentation, they said, Rosenberg, you know that the S&P hit a new all-time high today, and you're talking about a recession. And the recession started in December of '07, 2 months later.
Well, I mean, I think we went back and looked at it, and we saw that, you know, right before you go into recession, we historically, that quarter before has a 2-handle growth rate.
Yeah.
Right? So it's
Yeah.
not that all of a sudden you grind your way down, it's that there's some exogenous shock. So think about it today. We've had this big repricing of yields. As you pointed out, it's been real yields. It's not been inflation expectations that have changed, right, this last 2 months. What breaks? Because the Fed's only going to acquiesce once there's a break. What do you think is the signs that our investors out here should be looking for?
Well, I think that everybody in the room should be really focused on the stock market. And because I said it has a sense of like '07, but it also has a bit of a sense of '87.
Those are not good years to compare on the stock market.
Well, I mean, oil shock, dollar shock, rate shock.
Kind of feels like we have all three of those.
Well,
right now, a
we
little
have
bit.
all three, but there's also significant, and Jeffrey, I'm sure, can talk this better than me, but there's some big liquidity issues as well, and I think especially in the Treasury market. But yeah, I think that I'd be focused on the stock market. I know people like to have their little arcane measures. We used to look at the TED spread, or look at this particular part of the yield curve, or look at the financial spreads. But I'd say the stock market, right now 4,200 is a line in the sand. But I'd say that the stock market is going to be very important to watch. Everything else will get priced off of that as far as risk markets are concerned. Now, you're quite right about credit spreads are nowhere near recession levels. But you see, this is what happens when we talk about the financial accident. And look, we're a capitalist economy, and there's boom and bust. And there is going to be a financial accident. There is going to be a severe impairment of cash flow. But you see, that happens after the recession starts. People don't have the right narrative. They think that, for example, I get all the time, well, but the corporate sector locked in these low rates, their balance sheets they're all good. 85% of homeowners, they locked in at the lows, they're all good, even though we have a totally sclerotic housing market where there's no supply and there's no demand. But you see, what happens with these interest rates that are going up? It's not about the capacity to service the debt. It's about the fact that we talked earlier, interest rates go up. So you're a business person. We've had an interest rate shock, a massive level shift. So you're a company that is thinking about embarking on a capital spending plan. You got your board of directors, but the whole arithmetic in the past several months of embarking on a CapEx project, because what you're doing is you're benchmarking your a priori expected rate of return on capital, assessing against the cost of capital. And that relationship's been altered. So capital spending plans are going to be shelved. That means that even though you can argue that post-COVID, employers, and you see this in the claims numbers right now, nobody wants to fire, but ultimately you're going to have to let people go. What companies have been doing instead of firing, by the way, is they've been furloughing workers. You're seeing a dramatic shift from full-time to part-time work. Companies are cutting hours, but they're not letting people go because of the horrible experience of having them being gone because of COVID and then not finding them again. And you talked about that mismatch, and so that's the big fear of the corporate sector. But at some point, you got to, take your finger, out of the dike, and in terms of the water flow coming out, we're going to get job loss, and it's just a matter of when. It's not a matter of if. It's going to happen, and so you get the job loss, and then you get the impairment of cash flows in the 70% of the economy at the margin called the household sector, and that's when you get the financial accident. Just remember, recession started in December of 2007. What was the financial accident? Was it New Century Financial in January that year? Nobody was talking about it, although it was on my radar screen. I mean, Countrywide came a while later, but Bear Stearns was in
March.
It was in March, and then we had, Fannie and Freddie. So you see, but the recession already started. You see what I mean? It's not like the recession created the stress. So people have the causation the wrong way.
To that point, Dave,
Yeah.
I think it's interesting because as you think through the whole dynamic of this, what a lot of the arguments that are being portrayed today are that, well, look, we've stomached 525 basis points of hikes thus far. It's fine. Look, the economy can take it. We've been growing. But what I'm hearing from you and what we've been thinking about for a while, it's a temporal issue. It's time. Time is the enemy of all of this, right? Because things get reset. Right? If you want to go borrow money today, you can't borrow at 525 basis points ago.
That's exactly right.
So time is the enemy of all these theses.
Look what's happened. Because everybody locked in their mortgage, they become prisoners in their home, right? You sell your home.
We went from being COVID prisoners to now we're financial prisoners.
Well, and that's why there's no supply. So you see how screwed up it is. You see the Case-Shiller index is up 4 months in a row, and house prices are going up.
We're right near the highs again.
But you see, the thing is that you have two, as they say in economics. By the way, this is actually a great venue for an economist because economics is an art, after all. So you have this very inelastic supply and demand curves. You have totally, very flat curves, and if just one curve called demand is a little bit above the supply, you get home prices going up. The housing, and you get people thinking, because the home building stocks went up because mortgage rates went down. Back in the spring and summer, I'm seeing these clowns on CNBC. I mean, everybody but you, mind you. That we're in a new bull market on housing. They're thinking, oh, okay. Not so sure about that. But the thing is that's the recession. The recession, you see, the recession is not caused because interest rates went up and I got to reset. No. It's all about what is GDP. What is GDP? GDP is new spending. So it's not about, so I'm not providing any big, scary argument that, about the debt servicing side. Good. So the debt servicing side, although you're quite right that we're going to be paying the piper. People locked in. That's not what the recession is about. The recession is about the fact that at this new level of interest rates, you cannot afford to buy a home. It's funny, right? It's funny that despite the fact that everybody locked in their mortgage, housing starts are collapsing again.
Because you have an 8% mortgage rate.
That's right, but what's that got to do with people saying, they go on Bloomberg or Fox Business and it's all good because everybody's locked in. So everybody's locked in. Good. So we're not going to have maybe an unmitigated financial disaster, ... yet, but the new spending is going down because of interest rates. The capital spending is going down because of interest rates. Now, what happened this year that caused the recession to be delayed was fiscal policy. And I'll just say right now, mea culpa, you have to have a model. I had a model, did not have enough of fiscal thrust. Yes, I did not think the savings rate was going to be with a 3 handle right now. And I did not think we're going to get double-digit growth in consumer credit usage. But these things are basically all over, but that gave you this feeling that everything's okay. It's this artificial feeling because you're quite right, that interest rates do hit the economy with a lag, and the fiscal stimulus is basically for the household sector is ending right now. And the excess savings, that theme has run its course. That was a much more powerful theme than I thought it was going to play out to be, but it is what it is. But the lagged impact of what the Fed has done stares us in the face, right? So the average lag historically from the time the Fed starts raising rates to the recession is about 2 years. And they started raising rates in March of 2022. And so I don't think we've given the lags long enough. But then again, we had this period where there was an Energizer Bunny impact from fiscal policy. Look, it reminds me a lot of what happened in '07 when I was at Mother Merrill. My nickname at Mother Merrill, by the way, was not Perma Bear. They called me the skunk of the picnic. And nobody wanted to have lunch with the skunk. But you see, the thing is that everybody was saying to me, I was under tremendous pressure. In fact, they were forced, ultimately, the head of research did a 360 with an external consultant because I wouldn't change my view. Do you know, at one point, I was told that, do you understand that with your macro forecast, 2/3 of the analysts, this is in the summer of '07, 2/3 of the analysts are going to have cells on their companies. So I said, but maybe they should. And she said to me, wrong answer. And so the thing is that, but look, I held my ground, and I guess I was pretty lucky. I guess the clients in the II surveys like my joke book because I managed to keep my job. But that year, when you go back, there was something going on that wasn't fiscal policy, but kept the economy going in '07. I thought the recession was going to start at the beginning of '07, started at the end of '07. People thought I was right, but I was crazy early. However, what happened that year was the last vestige of the housing bubble kept the Energizer Bunny going. What am I talking about? I'm talking about a different acronym, not YOLO.
ELOC.
I'm talking about MEW. MEW, remember MEW?
Yeah.
MEW, mortgage equity withdrawal, cash out refinancings. Household sector was still doing that right till the very end. And then the recession that nobody saw coming, December of '07. Okay, 3 months before Bear Stearns. So the recession has the impact on what's going to happen in terms of spreads widening out. So I think that's what the story is, that once again, we had not MEW and not cash out refinancings, but we had the last vestige of the excess savings file influencing consumer spending. But you see,
And
that story is over.
Well, as a consumer, you don't just change your behavior, you become acclimated to that lifestyle, right? And so you want to find new ways to continue to live that way. It's not that all of a sudden you say, my excess savings are gone. You know what? Now I'm going to tighten the belt and be austere. It says, how can I continue to do more, right? Or how I really like this lifestyle. And so I think that's part of what you're pointing out. But I think it's funny, you talk about the long and variable lags, and I think the Fed put out a piece earlier this year. One of the regional Feds came out and said, no, this cycle is different, which is always scary, right? But so this cycle is different because we have forward guidance, the market knows what we're thinking, and therefore the lags are shorter. To which I came back to the debt stock and the service coverage. I said, it's probably going to be longer this time than we think about. And that's probably how they were able to get away with the 525 to date, is because it hasn't rolled over enough into there. But again, this time being the enemy. So why are capital markets kind of ignoring some of that?
It's a classic case of cognitive dissonance, right? That the same people that say that all the rate hikes have already been felt, the same people saying that all the debt's been locked in. Let me think about how is that possible? But if the debts are locked in, it means that the lags are going to be longer.
Yes.
So you're asking me about I cannot understand that narrative because it's so illogical. But I don't know what to say. The thing is that we are in a business, in the financial business, and I'm not talking about your business, because you're going to trade with where you think the markets are going, bullish, bearish, or indifferent. But the pressure on Wall Street analysts and economists to be bullish at all times is absolutely incredible. Mm-hmm. And nobody wants to hear a bearish story, and I get that. So I don't have a great answer for you. I could just say that what's happening right now in the markets is this, that the bond market is basically stood up and paid attention to the Fed, that the higher for longer. And now, I'm not a big proponent of that, but the Fed has the market convinced right now.
Let's
And
use
the
a
stock
wonky term real quick, a wonky term on that,
Yeah.
because we keep seeing that the term premium has increased, right? That's what we keep hearing about, because obviously Fed
Yeah.
funds hasn't moved, right? So it's this term premium. What do you make of that?
What do I make of the term
Why
premium?
has the term premium increased? Is it a
Well,
neutral rate? Is it the fact that
No.
we're going to have better growth? Why would the term premium increase?
Just because the Fed has, firstly, they've consistently increased where they say the terminal rate is going to be, point number one. And then, I mean, they don't give out forecasts. I guess they'll say long-term, we'll go back to whatever they call neutral at 2.5%, but you don't know when. But look, for the next, say, 1 to 2 years, they've raised the average level of the funds rate, right? And it's not as if their long-term forecasts, they cut from 2.5 to 2. So what's happened is that the average funds rate for the next number of years mathematically has been taken up, and that's what that's what's been reflected in the bond market. I'm good with that. I think that the Fed is focused on lagging indicators. I think that we're going to get a recession, and I think it's going to be a big surprise to a lot of people. The Fed doesn't have a recession in their forecast anymore, but I think that they will be surprised. Yeah. And I think inflation, I think this time next year, there's a significant chance that the inflation rate is going to be below zero. Below zero. Below zero. And I'll tell you why. It's just pure math. The San Fran Fed, that actually, and that's your Fed. Now, maybe it doesn't have the greatest leadership when it comes to overseeing banks, but
I'm shocked that Mary comes out there and shows her face anymore.
But their economic research is the best, followed by the New York Fed. So we see what's happening, right? Like we see that I think it's been 3 months in a row that the year-over-year trend in the apartment list rental data, and that's new leases, have been deflating, like negative. And the national vacancy rate has already gone up above the pandemic highs. Like the vacancy rate, and when you look at the record number of multiple units under construction, I imagine they'll have to be mothballed. We're getting dramatic excess supply in the apartment sector. This is important, not because I'm some Mr. Housing guy, but because of the way that the government constructs the CPI. A third of the CPI is rents. And the San Fran Fed, and I'm not going to say we verified their research, they verified our research. I don't think I have any PhDs on staff. And they said that by this time next year, the rental component, that's a third of the CPI, and 40% of the core, that the rents year over year are going to be 0 to negative. So think about that for a second. It's running at 8% year over year right now. They're saying it's going to go to 0 or less, a third of the index. I mean, you just basically subtracted almost 3 percentage points off headline inflation.
What do you make of this whole idea of Jay bringing up this concept of super core inflation now? I call it the anti-Malthusian trade. You get rid of energy, you get rid of food, you get rid of housing, right? The basic necessities of life. And what do you make of, why would we focus on this metric? Like, we know the OER, we know the lags. Why bring this up?
Well, you know, if you excluded everything from the CPI, it'd be 0. So, well, there's a reason. There's actually there's a reason why they went for the super. You know what this? It's the Powell Services Supercore CPI. That rolls off the tongue. So it's basically X energy, X shelter services.
Right.
Why? Why that metric? It's only 20% of the CPI, but
right.
Why that metric is because they believe that that was a guide for tightness in the parts of the labor market they're most concerned about, like leisure, hospitality, retail. So they were looking at that specifically, not targeting it, but using it as a guide for supply-demand imbalance in that part of the economy, which they were most concerned about. They weren't concerned about manufacturing. They weren't concerned about the export
Because it's been
sector.
recessionary for 18 months.
Right. Well, of course, they wouldn't be raising rates, but that's that's why they're looking at that particular aggregate. Which again, what did and the number?
So is it also they're using that to rationalize what they're actually executing?
Yeah, I'd say. Well, the answer to that question is yes. I cannot believe how hawkish they were September 20th. I'll just say right now, I cannot believe, even though you can argue that the economy has done better this year for the reasons we stated, and this is not, if you were looking at this as an equity analyst or in a financial statement, it would have an asterisk. The growth this year was basically non-recurring. This was non-recurring growth in the economy.
It sounds like a way of explaining financial statements.
Let's say that and I think everybody got carried away with the Atlanta Fed, right? 4.9. But meanwhile, the New York Fed nowcast is like 2.1. The St. Louis nowcast is at 1.6. But the holy grail of the Atlanta Fed. The fourth quarter, I was going to say, I think the fourth quarter, a lot of the Q3, everybody's Q3. Look. Q3, what happened in Q3? And what happened actually in Q2 and in Q3 was that the automakers were ramping up production like it was nobody's business and building inventory ahead of the strike. That's the story. Then that had big spin-off effects, and they were right. The UAW went on strike. So you're getting this third quarter bulge, whether it's 1.6 St. Louis Fed or 4.9 Atlanta Fed. You can drive a Mack truck through that range, but that's what economists do, right? We have ranges of 0 to 100 and everything. But I think the fourth quarter is going to be really tough, and the first quarter even tougher. And so, I don't know. I think that we just tend to live in the here and now. I'd say that the Fed has been following contemporaneous and lagging indicators to an extent I've never seen before. I've been doing this for 40 years. And I'm not going to pray to Alan Greenspan or Ben Bernanke or Janet Yellen, but I'll say that I have never, ever seen the Fed react this way. I've never seen the Fed react this way. I said before, now not the year-over-year trend, not the year-over-year trend, but the reason why you look at 3-month trends, 6-month trends as they tell you momentum. I look at all the indicators, 3-month moving average, 6-month benchmarked against the year-over-year because they tell you where's the year-over-year going. I want to know where's the year-over-year today going to be down the road. The 3-month trend in core inflation is at 2.1%. Does that scare anybody in this room? No, I know. People say to me all the time, but look at the price of eggs. Look, prices are, I said by this time next year, CPI could be flat or slightly negative, but the US economy doesn't normally deflate for long periods of time. It's not, but Paul Volcker is known as the greatest inflation dragon slayer of all time. But nobody ever talks about the fact that in a 7-year tenure, from 1979 to 1986, that the price level went up 60%. But he took inflation, which is a year-over-year percent change. It's the first derivative from 12% down to 4%. Everybody says, but the Fed's got to prices have to come down. No, prices do not have to come down.
They just have to go up a lot less.
Just go up, exactly. But the Fed has me worried. And I'll tell you that the Fed, I think, made a mistake in 2 directions. And people can't see that because we've sort of been flooded with this fiscal that's not going to be a factor next year. You got to think that, this is why like these, these guys in the Freedom Caucus, they have whatever their own agenda, but they already agreed with raising the debt ceiling limit that they're going to be cutting non-defense discretionary spending by 2.5%. By the way, that's with the CHIPS Act. So we are going into a period in the next year where we're going to have fiscal restraint, and then the lagged impact of everything the Fed has done. I think, I can't, I'm trying to understand what the Fed is doing because that's what clients pay me to do. I totally disagree with what they're doing. I would not do I would not done maybe the last 100 basis points of rate hikes. But you're right, like who would have thought that you have 2.1, what happened in the last employment number? 170,000, we're gonna get a fresh one tomorrow. Did that scare anybody in the room? The unemployment rate went from 3.6 to 3.8. The participation rate went back up to its pre-pandemic level. And you know that the level of unemployment, like you wouldn't have guessed this. If I told you a month ago, the level of unemployment in the month of August went up 500,000, 500,000. Would you have guessed that we'd have like a 40 basis point increase in bond yields? Would you have thought that? Would you have thought that? Now, it's not, businesses do not let 500,000 people go. What happened was that you had a boatload of people coming into the labor market that couldn't find a job. Now, that's a benevolent way of getting the unemployment rate up, but frankly, I don't care. It comes down to your wage question. The unemployment rate is starting to creep up. And here it's crept up without even job loss, ... yet. Because for whatever reason, why is that? Why is that? Why are people coming back in the labor force? Because they have to. Now that the fiscal, all those quarters in the sofa, they're gone. I can't find them. And not just that, but when you look at the behavioral stuff coming out of the employment data, you're going to see that there's been this massive shift, I said before, not just full-time to part-time, but the biggest growth in the employment data is in multiple job holders. Multiple job holders, people that used to watch All in the Family, remember? Archie Bunker drove Muncie's cab at night. So what's that telling you? That is classic consumer strain. When people start to take on more than one job, they don't do that because they want to. They do that because they have to.
Maybe they're tired of being prisoners in their home, David. No. So with that, I could listen to David talk for hours. I don't know about all of you, but I have so many more. I have so many more questions. However, let's open it to the audience. You guys came in. Sir, you're quick and you're in the front row. You get the first question.
David, you said earlier that you're surprised, why is the bond market not listening to the Fed? But it shouldn't be the other way around. The Fed should be looking at the market. I mean, we can all agree the market's the smartest person in the room. It's the market forces is telling us what inflation is, and the Fed should be following the market. Don't you think so?
I completely agree. I was saying that, the best call I made, by the way, was last year when I said when the yield curve inverts, every Tom, Dick, and Harry economist is going to be saying, forget the yield curve. And of course, that's what he did because he did every cycle. We've had 14 Fed rate hiking cycles in the post-World War II experience, and 11 landed the economy in recession, 3 didn't. Mid-60s, mid-80s, mid-90s. Remember when we hailed Greenspan as the maestro? What made those tightening cycles different was the Fed, once the yield curve showed signs of inverting, it pulled back. It pulled back. This Fed just kept on raising rates. The yield curve inverted in July of 2022, yes. And they just kept on going. And there's lags. Those lags could be 2 to 3 years. And so I totally agree with you that it's going to be interesting to see, they release, what's the lag? Like every 5 years, I think, the FOMC transcripts.
It's something like that. I don't know the exact, but.
And I read these things just to show you what I do for fun when I'm on the tarmac. And I'm going to be interested to see what the discussion was. Because I think that a lot of this is just absolute hubris. Is this being taped? It is, isn't it? No, because I've got to say, I'll say it.
We may edit it if you need to,
look,
Dave.
The Fed is a non-paying client, so I don't really care. Yeah. It says this is the I must put it politely. The strangest Federal Reserve I've seen in my 40 years in the business. And I'm trying to make them out. They are not, their reaction function to everything is not what it used to be. Policy is so tight. But, and I could see that there'll be a time in the next year where all the people saying higher for longer and saying, inflation's sticky, then that narrative is going to change dramatically in the next 12 months.
And you know what that means? Bonds offer real yield today.
Yeah.
Something we haven't seen in a long period of time.
Well, you could buy the stock market with a 5.5% earnings yield, or, I'm looking at this thing, look at, 5-year real rates, 2.5% plus inflation.
Yeah.
I don't know. There's no such thing as a no-brainer in our business, but that's pretty darn close.
It's getting cheap.
But I think, you're taking a look, for example, I would say all roads have to lead to lower bond yields. All roads. We have an affordability crisis in this country. The affordability ratio, the National Association of Realtors, 3 variables, right? Income, interest rates, home prices. Now, unless we have a massive income boom, or unless home prices collapse, to normalize, we have a 2-standard deviation event in the affordability ratio, which is a mean reverting ratio. It's a mean reverting ratio. What is going to be the variable that equilibrates it? Probably home prices and interest rates. They have to go down from here. They probably have to go down a lot. Looking at, for example, the equity risk premium, how could anybody who's rational, looking at the equity risk premium, this is just pure math, it's 80 basis points. 80. It's a mean reverting series. Ratios mean revert. What's the long-term ratio? Was 30 basis points, 300 basis points. So equity markets have to go down and treasury yields have to go down, and then we'll reach some equilibrium. And if you do a matrix, you'd say, oh, okay, if we get down to like 3% on the 10-year note and 3,300 on the S&P, that's a new equilibrium that actually brings you to a normalized ERP. So I'm very bloodied, unbowed. I'm like a whack-a-mole. But yeah, look, come on. If I like treasuries at 3.5, I got to love them at 470, don't you think?
So. But you can see
especially because my fundamental views haven't changed.
But you can see that even though he's bloody, he's battered, he still makes a lot of sense, right? So, David, thank you today. I got to get my boss up here, so thank you for your time. Everybody, David Rosenberg.